just yesterday, which was a good day after carnage for the last few sessions. Global markets are not too bad either. How are you approaching investing right now?
If you're looking at from an India market perspective, let me give you one event which is going to be of significant importance is of the China. And you look at the way China is, for the last 10 years, they have done trade liberalization, they have achieved a global position on the trade side. And now China is moving towards a situation where they would like to change the financial position significantly. And that comes from a backdrop of that they would like to see a renminbi SDR moving in, which is in November, which is in a 5-year cycle which comes in November. And they would also like to open the account, the financial account. So you would see a lot of money which could flow into the stock market of China. And this would also mean that there's some changes which has happened in the Hong Kong side, and there's more changes which could happen on the China stock investing side. So from a global market side, we have Japan, which is started doing very well. And there is, for the last 2 or 3 years, what all the inputs what the government has done. And also the changes in the corporate governance structures on the Japan side. So you have Europe, which has started seeing some kind of recovery, and you've got some stock markets doing well there. You have a China, which is doing very well because of the changes on the macro side from the Chinese government itself, and you have a Japan, which has started doing well. So in that context, global markets look good, but at least from the India perspective, you would have a situation where this money could find a home in these bigger size of the markets.
Let me just give you some data on Chinese stock markets. China has added 4.4 million demat accounts in the month of May. India has 60 lakh demat accounts. I've been told that $50 billion has been raised by Chinese companies in 2015. The market capitalization of China has gone up by about $1 trillion in last 1 year. Isn't that a bubble?
That's not a bubble.
That's not a bubble.
That's not a
China
bubble.
Asia, look at the valuations there.
Oh yeah. It's we all get sucked into this. If something has moved up, that's a bubble because we don't understand well enough. There is no. Okay. So let me argue with this. There is a thesis behind this. China's world MSCI World Index, the China share would be close to 2.6%.
22%
on a world index. World index. I'm not talking about Asia Pacific. World index. And Japan would be close to 7.7%. Somewhere you will find China settling down and going up significantly. You can't have a Chinese economy with the kind of representation they have. So India, so let me remind you back that India has been a beneficiary of the Chinese market not doing well for long enough. And that's the reason that trade globally was that you set up your manufacturing facility in China and you do make investments, financial investments in India. And that's been going on for long enough. So now you have a situation where the Chinese have started opening the financial markets. They are looking at a lot more easing of the introduction of the capital into the Chinese market, and rightfully so, because they have a leveraged companies. And if you have a leveraged companies, one of the reasons you can improve the leverage is also by introducing the equity in the stock market situation. So Chinese market would be trading, including the bank, Shanghai Stock Exchange would be trading what was 25 to 30 P multiple, and if you exclude the bank, those P multiples will be significantly higher. So what you have is depression of the P multiple because of the banks. But having said that, if you are looking at a situation in the next 3 and 4 years where you would see the revenue be getting much more internationalized, and you would see that a lot of money would flow into the Chinese stock market. And if there is the reforms which has been done on the Chinese markets, and I remember last 2 years back I saw some changes where on the dividend policy itself, the Chinese,
The question is, and we need to slip into a break as well, but the question is simply this: would that money flow into China at the expense of India, or is there enough money sloshing around and dedicated to growing markets like India that markets like India don't get impacted, even if your thesis is correct?
Yeah. It's very difficult to make a statistical argument that this is how the Indian money would move out of India. But if you look at the argument which has been played around, that the premium of India has gone down. So what does that premium mean? That premium means that the money was not finding its home in other markets, and you suddenly have seen a area where the money can find, and that is the big markets, including China, including Japan. So these are the revival of the markets, and I'm sure for a considerable period of time people were underweight on these markets. So you have to correct your underweight positions, and maybe finally people will go to the overweight positions.
The reason I was asking him this because of the conversation that we had with Jonathan Garner yesterday, right? He said that he's bullish on Japan and the other markets, but within the EM pack, India still remains the favorite because of the ROE differential and the earnings quality differential.
So Manish, what would it take for India, or for that matter investors, to now turn tide and switch to India? What would have to change on ground?
We don't need to look at the whole situation that it's a one man gain and other man's loss. So you could have India and China both could exist. These are the short-term trades where one overweight market gets toward the other underweight markets, and these kind of corrections does happen. All depends upon your time frame. If you are a patient investor with a 3-year horizon, then India is interesting because you will have a cyclical recovery next 9 months or a year or so, and then you would see the benefit. And at this point of time, you may go back a year back and say, oh, that was a time to really to buy, and that's what usually happens.
So very quickly, what do you buy, since right now is the shopping time?
If right now is the shopping time, then you have to buy the industrial recoveries.
Industrial recovery.
Yeah,
so
that's right. That's
companies which would benefit if India comes back.
India would come back.
So what do you buy? Cement, you buy machinery, do you buy capital goods?
I would not base my decision based on the sectors. I would look at where the earning momentums would be good. You could have a cement company which is not doing well and which may not do well because of the market positioning or whatever may be the case. So finally, you would buy where the earnings delta would be best. And for that, you have to look at very stock specific, combing those stock specific areas, and then you would.
But PSU banks in general, you don't have to look at the sector. You only have to look at perhaps valuations there.
Yeah.
Would you buy PSU banks with the assumption that if economy comes back, NPAs will become, bad loans will become good loans, and they will lead the recovery cycle?
Given a choice, I would not buy. And for a considerable period of time, till I see a perceptible change in the corporate governance structure of the PSUs, till I see, for us sitting, all 3 of us here and all 4 of us here sitting here and make a judgment that the PSU banks, the big value destruction is over as a shareholder, because it's the shareholder who's less left with the finally the mud and the muck with. So it's very difficult to make that judgment. So I would give a lot more time before I see perceptible change. So 27 PSU banks are headless at this point of time, I'm told, and then we have to see the combination what finally evolves down, and maybe the loans plus restructuring loan has to go through a different cycle. And also, if you look at the gains over a period of time has been in the private financials, not in the PSU banks. So why I would look at it? I have no compulsions to look at a PSU banks or a PSU bank as a pack.
So earnings visibility is the key parameter to pick out stocks. What else? Very quickly.
If you look at a theme, then I would suggest that if you look at what government is doing and overall architecture of the way government is positioning themselves, assuming we all agree that GST would get implemented in some point of time, some form, shape or other. So one of the biggest beneficiaries in this implementation would be the industrial brands, because there is an organized market, there is an unorganized market, and the whole transmission would happen. So you would find the industrial brands much more valuable than what you are seeing today at this point of time. So that would be a theme which would definitely come into play.
Okay, I just have one very quick question. Yeah. If indeed the thesis is that China markets will do well, which means that the economy should do well, which means metals in turn should do well. Metal as a sector is distressed right now. Tata Steel, blah, blah. Have you what? Would you buy into metal names?
Answer is no.
Okay.
I said China stock market will do well, so that doesn't mean the China economy will go back to 9% or 10%. And I think post 2008, we have tested all the contradictions what could possible, that we have best of the stock market and worst of the economic cycles. So where the world is seeing deflation, and we have seen one of the best stock market cycles. So I would not touch metals at this point of time, because the metals were significant beneficiary of the incremental and huge appetite of the China, whether it is iron ore and the steel and anything. So I don't see that situation coming back again, and maybe we will see contraction in those. And at this point of time, one of the biggest grouse of the steel industry is the import from the China, which would be close to 10% of the size. So you have a sector which is importing deflation, a country which is exporting deflation to others. So why should I be an investor in that?
On that note, Manish Bhandari, so good having you. Thank you so much for taking the time out and joining us in our studio.
Thank you.